Hello, this is Jordan, and this is your precious metals video market update. This is being recorded on Tuesday, January 27th, 2015. And I'm just going to focus on gold today and the US dollar and currencies. And first, in this chart, we have at the top gold against the foreign currency index, and then gold and US dollars at the bottom. And the foreign currency index is essentially plotting gold against the inverse of the US dollar. So we're plotting gold against the foreign currencies and their weight in the US dollar index basket. So the euro obviously has the biggest impact, the yen the second, and so on and so forth. And what we see here is that gold against foreign currencies has often been a leading indicator for gold and US dollars. And I've noted that on the chart. I mean, you go back to the beginning of the bull market, gold and foreign currencies was making new highs first. In 2005, remember when gold and the dollar were rallying together, gold against foreign currencies broke out, made a new high first. And then we saw the same thing during the financial crisis, where gold against foreign currencies bottomed first, and then it broke out to a new all-time high months before gold broke 1,000. And now we're seeing that again, where gold against foreign currencies bottomed at the very end of 2013, has not made a new low, and of course gold and US dollars made a new low. And now gold against foreign currencies is trading at about a 21-month high. I mean, if you're comparing that chart to gold and US dollars, using the same scale, gold against foreign currencies is trading around $1,500 an ounce. So gold is really showing a lot of relative strength, but of course, eventually it's got to show strength against the US dollar, and that's something we're going to look at in the next slide. And we have the dollar here going back to 1979. Of course, it started trading in 1971. And what we plot here are three oscillators, and we're showing the dollar's distance from its 10-week, 40-week, and 80-week exponential moving averages. Now, sometimes when a market gets overbought, it's a good sign because it's a sign that momentum is building, and especially if you're coming out of a downtrend and you're kind of early within a new trend, the market can get overbought. That's something that's not necessarily a sell signal there. But with the case of the dollar and looking at these oscillators, showing how oversold or overbought the market is, essentially the dollar right now is at its third most overbought in history. So that's since 1971. The other two times were at its peak there in very early 85, or was it the end of 84? And then the second time was at the end of 2008. So just by looking at how far removed the dollar is from these various moving averages, that's how we come to that conclusion. Right now, looking at the 80-week moving average, so I mean that's a pretty big time frame there. The dollar is the second most overbought ever. And looking at the 40-week time frame, the dollar is the third most overbought ever. Not quite as overbought on the 10-week time frame, but still very, very close to it. And another thing to note, I think the dollar hit a 50% retracement. I know people have been talking about that. But looking at, I mean, this is a serious overbought condition. And so at the least, we're not saying this is some major top for the dollar, but at the least, if the dollar is going to keep moving higher, it's going to have a pause, at least for a couple months, maybe 6 months, maybe most of the year. And on top of that, if you look at sentiment, a public opinion from sentimenttrader.com, which goes back about 15 years, the dollar, I think it was 92 or 93% bulls recently. That's an all-time high. The daily sentiment index a few weeks ago hit 98% bulls. I mean, that's a little more shorter-term sentiment indicator. But what we're seeing here is a market that's really ripe for reversal, and the dollar did have a bad down day today. And the important thing to keep in mind is, as we showed on the last picture, gold has been very, very strong against foreign currencies. I mean, gold has gone up to 1,300 with the dollar going through the roof. And normally you don't see that. I mean, it does happen at market turning points. But the fact is, what's going to happen now if the dollar has a correction or a counter trend move in the weeks and months ahead, I mean, that could be enough to push gold materially higher. I'm not saying it's going to go to 1,500, but gold has support at 1,250, and its next resistance is kind of 1,330 to 1,350. I mean, this could be the setup for gold going above that resistance, and if it does, I think you'd see the remaining bears really start to capitulate. So that's something to keep in mind. Another thing I want to touch on before I close here is the COT. I mean, every time we see gold go up or silver go up, there seems to be some kind of panic about the COT. And what I have here is I'm looking at the net speculative position as a percentage of open interest, and then you're breaking it down further. We have gross shorts, gross longs, and also open interest. When gold was in a bear market, looking back the last several years, when gold was rallying, it was mostly short covering. There wasn't a lot of buying, a lot of speculative buying, and that's something that you need to see. I mean, ultimately, over time, if you expect any commodity or anything in the futures market to go a lot higher, there's going to be more speculative buying. So it seems to me it's kind of a knee-jerk reaction from some folks that, oh, gold's gone up, but there's way too many speculators in the market. The thing with sentiment indicators is we have to focus on them at extremes. That's when sentiment itself can be a big factor. When it's not at an extreme, it doesn't play as large of a role, in my opinion. And the other thing, you got to focus on the price action. Again, gold right now is kind of in between support and resistance. I said 1,250, resistance at 1,330 to 1,350. So to me, that is more important than the COT. And back to what I said before, I like what's happening in the COT. I mean, gold, the open interest is broken out. It's at one of the highest levels in the last year, maybe the third or fourth highest level. The gross long position has gone up in the last few months. I mean, it has gone up quite a bit. I mean, I would think that gold would be higher given that, but nevertheless, I do think it's a good sign that we're seeing some more buying come into the market. We're seeing more interest come into the market, and so that is a good thing. And I think the COT is not, if I'm a gold bull, the COT is really not a worry right now. I think the bigger worry would be, what happens if gold trades up to that 1,330, 1,350 resistance. That's where you could see a reaction. And if you go back and just look at the net position over the last 15 years, the COT as a sentiment indicator, it doesn't always give you perfect tops and bottoms. I mean, look at the COT in early, mid-2009. It reached one of its highest levels in a long time, and gold kept, I mean, it had a little correction there at the end of 2009, early 2010. But other than that, gold continued to steadily move higher for the next couple years. So let's not make too big of a deal out of the COT. I think price action is way more important. And looking at sentiment indicators, you want to see something hit a real extreme like what we're seeing in the dollar right now. That's all for today. Thank you so much for watching and listening. You can check out my website at thedailygold.com. I have a free newsletter and I have a premium service. Thank you for watching and listening. I wish you all the best in 2015.